Good day, everybody. This is Jim Kinney for the weekly market update for OptionProfessor.com. And the date, of course, is March 1st, 2019. As I always say each and every time, past performance is not necessarily indicative of future results, and also that short-term trading, option trading, involves substantial risks, not right for everybody. Check with your brokerage firm, your advisor, and your good common sense before you entertain any ideas on any investment. Again, many of you have been regular listeners, viewers. I would like to say that by way of introduction, I'm Jim Kinney, and I'm a graduate of Boston College, and I've been in the investment arena here for decades. Been educating people for the last decades on option trading through live and webinar type seminars. Thousands and thousands of investors and hundreds of seminars. And so today I'm going to be giving you my views and my observations. I'm reminding you that if you do have any friends or associates, do let them know that they can go to the website, OptionProfessor.com, get the link every Friday and get an update. Also, those in attendance or those who are going to be in attendance can also email me with any question at all that they have to OptionProfessor at gmail.com. That's OptionProfessor at gmail.com. Okay. All right, let's get into it. We've got the Dow Jones today, as you can see from the screen, rolling over a little bit. It was higher, and now it's rolled over from the 12,150 level, so it's lost pretty good amount of altitude. Same thing with the NASDAQ. As I've been telling you, and just to give you a quick review, when we were way down at 2350, the idea was that we might go back towards the 200-day average, which we did. And every pullback obviously was a buying opportunity till we got to about 2750. Now, we've gone through 2750, and I brought to your attention last week and the week before that the Elliott Wave people were looking for the 2800 ballpark area with an outside chance of 2940, which is the all-time high, on this move before we get a correction. So they did hit their first level here this week. And during the broadcast we had on Tuesday, when we were at 2813 and the VIX hit 1344, I brought to your attention that it looked like the market might be rolling over, and some of the other gentlemen on the broadcast did it as well. Momentum indicators were very frothy, and the VIX, which was down at 1344, jumped about 5 or 6% during that day, and it was giving an indication that we could be rolling over from the 2813 level. Right now, that looks like what's going on. Don't discount the concept of maybe going to test that high, but let's be frank, it does look like it could be rolling over a little bit. Let's look at a couple of other indicators that I've been watching. How's the transportation average been doing? I thought if it broke under 10.5, that would be something to be concerned about. Let's take a look here. Yeah, it's at 10,479. It's up 12 today, but it busted below it yesterday, apparently. And so, obviously, if you look at the graph as I am right now, if we can get underneath this week's lows next week, that would indicate to me that you probably are going to see a drop. Conversely, if we start making a new high above the recent highs there, going up to 11,000 is not out of the cards, and that might take you towards the high of 2940 on the S&P. So again, there's something to keep an eye on. If the transports break to new highs, figure the S&P will do the same. If the transports break under this week's lows, then again, a further downside move on the S&P could very well occur. Obviously, 2750 where those or 2740 where the 200-day moving average would be an area of possible support, and then further down between 2600 and 2650 would be what I'd consider longer-term support. So if you're a bull, those are the two levels you'd like to see hold if it does pull back at all. Let's take a look at your VIX. The VIX hit 1344 this week, as I mentioned earlier on Tuesday. Now it's trading 1427. Still really can't get out of its way. So that's why, you know, the bearish pullback is still premature a little bit. But you can see the setup is a little bit of a 1-2-3 formation. The one move was the recent jump up towards 16, 17, whatever, that area here. Then the pullback is the one we're in right now. If you don't take out 1344, which is this week's low, and you take take out this week's high on the VIX, that would also indicate to me the market is rolling over. So there you got some things to watch. We're kind of in no man's land here, wherein it's a little too strong to sell and maybe a little too overbought to buy. Sometimes the market gets that way, and sometimes doing nothing is a legitimate strategy. This might be one of those times. Wait for the market to tell you what the next direction is, because you don't want to be stepping in front of a freight train. If we're going to go up and test those highs of 29.40, you don't want to be shorting it here. Conversely, if the thing starts breaking underneath the transports underneath that area that I mentioned, this week's lows, or if the S&P takes out this week's low next week, that would be indicating that maybe the sell phase is in force. Keep an eye on those three things: the transports under 10.5, or excuse me, this week's lows, the VIX getting above this week's high, and the S&P taking out this week's lows. If you get that trifecta, you might want to be prepared for a down move or at least a pullback. And a pullback, how you would prepare with that might be either married puts. What are married puts? That's where you buy a put contract against stocks you own, knowing fully well, like any insurance, if there's no accident, meaning if it doesn't drop, the put could go to zero and you'd lose the premium. Conversely, if something happens where the thing rolls over big time, you have insurance there that maybe didn't cost you all that much because the VIX is down at 14. And when you went to bed at night, you knew you had a floor under your equity. Obviously, sometimes it's a very good feeling to have, particularly when the market goes into the tank like it did in December. A couple of puts probably wouldn't have hurt your portfolio. Second way to hedge it, of course, is the collar strategy. That's where you sell the out-of-the-money call and then you buy the put with the premium. If you're not certain how these strategies work, that's another reason why you shoot me an email, and I can correspond with you very easily. So again, it's OptionProfessor@gmail.com. Options generally are used for three purposes. One is for hedging. That's what I'm talking about here, meaning you're trying to put parameters around your equity so that obviously you have some idea, worst case scenario, what your equities would be worth. Okay. Secondly, it can be used for limited risk speculation. That's where you're going to have leverage and limited risk. So if you're wrong, you walk away with a limited loss, meaning the premium fees and also any commission you paid. And of course, if it runs big in your favor, you've got leverage going for you. And that can be a very attractive thing if you're on the right side of it. And the third thing, of course, is cash flow. And those are strategies like covered call writing and credit spreads and things like that, where you're trying to capture the premium because you think the options may expire worthless. Again, at the website and through the email, if you have any questions on things, don't hesitate to give me a call, and I'll give you my best shot as far as what I could do to help you. All right, let's see. In the news today, big one is Gap, right? Gap stores. Why is that? Because they spun off Old Navy. And so there'll be no more Old Navy, and they got a new company. I guess Nuco is the name of it, possibly, rather than the Gap store. So winds of change are blowing over there, and today everyone is buying into it like it's some kind of panacea, and it's up, as you can see, 25% today. We'll have to see if this rally holds, and if people don't take a step back over the weekend and say, you know what, they've gotten rid of Old Navy, great, but what do they have left? And then they're going to close these stores, and so there's a lot of who shot John going around, and maybe it's a situation where they will moderate some of their enthusiasm. There looks like a pretty big gap that they're filling too, as you can see. You're looking at a situation where it used to be having a gap between 26 and about 28, and so we're right into that gap. Once that gap fills, we might find out if this thing can hold water or not. Okay, so that's basically what's happening there. Where are people going to kind of hide out and try to make some money? Let's look at a couple of things that I've heard mentioned on the news. One is a telephone. And this is a company, obviously, that has a lot going on right now. And let's take a look at it real quick, because the dividend is 6.5%. So is that a bad thing to have coming in when you're watching something go up and down? Again, when you get a dividend like that and you own the stock, as it goes up, down, and all around, you're still getting a cash flow on your money that's very attractive. And a P/E ratio of 10 doesn't scare me either. So what does it look like technically? Let's take a look. again, this is just something I've been looking at, and something that my opinion says that might be something to keep an eye on. Again, not a great setup on the moving averages. 29 and 31 means they're still inverted, but you can see from the chart down here, it does look like it's got a little bit of a bottom form there, and it does look like it might be a head and shoulders bottom. And you can see my cursor's right over it. Now, if we start breaking that neckline, which looks like about 32, that would be getting above the 200-day average, right? That might be something to look for, and then you'd put a stop maybe underneath the low of the first quarter here, whatever the first quarter low is. Looks like just a little bit under 30, and then of course you're getting the dividend while you are getting paid the dividend, and so that's very good cash flow on your money while you're watching something that has it's a $226 billion company, so it's obviously a behemoth, and you're getting very well paid to hold on to the behemoth, and you're not buying it anywhere near the high down here. The high up there in 2017, you can see is way above 40. So, it's at a discount. It's got a good dividend. The P ratio is not too bad. And the moving averages are underneath the market a little bit with the 50-day. Keep an eye on it and see what you think. But that might be something to keep an eye on. And then everyone's drug crazy, huh? Drug madness. And so you're getting a lot of mergers and acquisitions going on in the drug arena. And so basically that is a situation that some people are looking at different companies. Now, how about we look at Pfizer? Pfizer, where are we? Pfizer, we're at 43.46. What's the dividend? 3.31. What does that mean? While you're holding onto the stock, you're getting paid a cash flow to watch the movie, right? Not as good as on telephone, and the P ratio here is over twice what telephone is, but you are looking at a situation where it is in an arena that has a lot of action going on, and you're getting a very healthy dividend to watch the movie, meaning to own the stock. Now, take a look at the graph here. Looks like it might have hit its lows down here in the 40 area. Looks like it's trying to matriculate up. Some resistance at 44, sure. But if we get through there, where are we going? Get above 46, you're into fairly all-time highs. Let's take a look at a long-term graph to put it in perspective here, because this thing has consolidated for quite a long time, and maybe this is the year where it gets off its gets on the horse and gets running. Let's take a look at the 10-year graph. Yeah, can you see here that this thing has obviously been going up and up and up, and you're getting a dividend while it's going up and up and up and up, good dividend, up and up and up, and now it pulled back towards 40, and if it takes out the 46 area, that's called all-time highs. I wouldn't mind seeing the volume pick up a little bit. Okay. And of course, if you take out 39 or 40, I would view that as very negative. So again, if you want to put a put underneath there to hedge yourself, that would not be an illegal act. And basically, that would give you some comfort that if all heck broke loose on the downside, you've got a put underneath protecting your equity. And maybe that dividend could help pay for that put. So that's an interesting way of conceptually getting involved in this stock while also putting parameters around your equity. I think it's important to put parameters around your equity if you can, because obviously then you know exactly what your equity might be doing in the future on a worst case scenario. With regards to another company that has gone into a merger situation and that I brought to your attention a while back, and that's Freeport-McMoRan. They bought Goldcorp, which makes them a very big outfit as far as the gold is concerned. Now, again, gold had a run up towards 1350 and has backed off. That's obviously a problem. Stuff that I mentioned to you at the 17 area on GDX has jumped up towards 23, had a pretty big move. Maybe hedge it up here a little bit, maybe take a little bit off the table here and see if this gold can break through 1350 and see if this stock and others can get on the bicycle. But why I would be looking at this would be because it is in a situation where it had a huge blow off to the downside. That very well could have been the low in 2016. That's when interest rates bottomed. And when interest rates bottom, sometimes that's when gold bottoms. Why would interest rates be rising? Because inflationary or dollar problems are starting to occur. And when that happens, interest rates tend to rise. What else happens when the dollar or inflation starts changing? That's when the gold and the oil can get going as well. So again, not coincidental. 2016, that's the bottom of this. 2016 is the top in the interest rate market, meaning interest rates bottomed around that time, ballpark area. And of course, that's also where the oil bottomed at around $35 a barrel, ballpark time frame, ballpark area. So is this interesting to me? Yes, it is. Obviously, you want it to stay above 10. And if you can do that, and if it gets above 20, it could get going to 30 pretty fast. And it used to be 60. So it gives you an idea that there is some potential to this. And now that they bought Goldcorp, they're a pretty good sized firm. There's also a hostile takeover going on with Barrick Mine and Homestay and Newmont Mining. So let's take a look at those two real quick. Barrick is at 1664. And again, very similar to Freeport McMoRan. It hit its bottom in January of 2016, which you will see in a minute if this chart will be cooperative. Okay. And basically, right there is the low again. And then we are trying to make a turn. If you can get above 20, and I think the way they're trying to get it above 20 is by buying Newmont. Right? If they can get it above 20 and they can get the Newmont thing done, then it sets the stage for this thing to possibly go up as well. So the merger activity in the metals area might be a signal that they know or feel that the valuations on the mining shares are low, and they're trying to make their acquisitions while they are low. Again, one last thing on GDX. And there, like I told you, we had a very nice move up to 2370. I brought this to your attention a long time ago when I thought it was bottoming down there. Well, let's go a little shorter term graph. And we'll go back to the 1 year. And that'll give you an idea. Okay. Yeah. So like I say, it had gone on a big move. And so after a big move, sometimes you do hedging, meaning throw a put in there to protect your equity, or do a collar if you think temporarily the highs are in, and then you protect your equity. But again, it had a very nice move from this 1718 area. I was showing you. There's the low. Take a shot. There's the low, take a shot. As it pulls back to the low, you take a shot. Now that it's way up here, obviously that's a big move. 17 to 24 is a good size move. So either you do a little hedging there. Now it did make a high above 23, but that might have been one of those things where they goose everybody and then they bring it back down. So again, we need gold to break above 1350 to 1400. We need this thing to get back above 25. We need the other mining shares to get moving a little bit, and we need the US dollar, which I'll show you in a minute here. And I'll be getting into the other sectors here right after this, so stay tuned for that. I'm just showing you something that I think might have some value longer term, which obviously it has had value since I brought it to your attention because you see the rally that it had. Now, again, it does look like it's hitting some resistance here and pulling back, but that doesn't mean the whole party's over if we can get this dollar to where I'm going to show you right now. This dollar remains in a range, but can you see that 94 level? And if it broke under 94, can you see there's nothing underneath it? Okay, so that's why you want to keep an eye on here. It has a double low here at 95, had a rally, but couldn't hold the rally. Now it's come back down. Again, if the Fed's on pause, if they're going to be running up the deficit through the roof, right? And if it's a situation where the earnings and stuff are not going to be that robust and things might slow down on the earnings front, then the US dollar could be more vulnerable. And again, 40%, I've been told, of the S&P earnings come from overseas. Who's to say that the Fed and those guys don't want the dollar to go down to help overseas earnings? So again, it could be by design that they bring it down. I mean, they're pausing for a reason. They're not pausing to make the dollar go through the roof, right? So again, if the dollar were to crack, and if you get some more momentum in the metals area, there could be good value there longer term for part of a portfolio. No doubt in my mind. So keep an eye on that, make your own decisions, but I'm bringing it to your attention. Another thing I brought to your attention was China, and China's been going nuts this year. And I brought this to your attention last year. And the one that I said to focus on is Alibaba. Why? Because it's huge. It's a big, if it's now look at what that's done since I brought it to your attention. The thing was down at 130, right? And I told you the moving averages were up at around 160. So when you get that far underneath the moving averages, I've told you many, many times before, you start taking a bite. Either you take a bite of the sell side if it's way above the 200-day, or you take a bite of the buy side if it's way underneath, depending upon other factors. But that's something that you'd watch. Now, this thing, again, has gotten ahead of itself a little bit. Again, but it was a heck of a buy down there when we were sniffing around those lows. Okay, now when it's up here, you could do something like what? Try to look at a put to hedge yourself. Try to look at a collar. Don't understand how that works? Give me an email. I'll try to give you a hand explaining it. But let's take a look at the internals here, because like I said, when we were down at 130, the 200-day average was well above it. And again, that was an indicator that it might be a good value down there. Yeah, look at the 200-day. It was at 167. We were at 130. You take $37 and you divide it into the 167, and you get 22% underneath the moving average. On a big company that's $470 billion, when you get 25% underneath its 200-day average or above it, that's an excessive amount for a huge company like this. So that's why you want to keep an eye on it. But again, after this big rally, you got to be careful that it could roll over a little bit, because there's resistance, as you can see, around 200, and we're not all that far from that. So a lot of this, China is going to get better, and China is going to get a deal or something, might be baked into the companies a little bit. The other one that I keep an eye on is Baidu, and that hasn't been quite as robust as Baba. But there has been some improvement in the stock, but nothing to write home about like in Baba. Here, again, having a hard time getting moving a little bit. And the other one that people watch or they keep an eye on is Tencent. And let's take a look at what that's doing. Those are the three big horses in the race here. Now, that's come off the low by about 30%. So 30% is not too shabby, but you can see it's running out of some altitude here. Not a bad time to maybe throw a put in, not a bad time to consider doing a collar, okay? That's China. Big move up, rolling over just a little bit. Again, we might be rolling over as well. Again, 28.13 this week. Circle that number. So far, that's the high on the move. Can't get above it. Next week, start taking out this week's lows. VIX gets above this week's high. Transports start busting underneath this week's lows. That's the recipe for a correction. If you get those things, don't look at it like a deer in a headlight. Do something about it if you want to. Okay, let's take a wheel around some of the sectors here, okay? I'm going to use some of the Vanguard ETFs. There's many ETFs out here. Let's, one last, okay, let's go through these things real quick. Okay, on the energy sector, it's up a little bit. This is one that obviously has not made as much of a move as some of the others, so the energy sector may have more to go. If oil gets above 60, it's going to make a bigger move. Right now, 60 is a lot of resistance. So if you see it above 60, plan on higher oil prices as far as I can see. Dollar breaks 94, plan on a weaker dollar as far as I can see. And there's your energy market. So it's definitely turned up, but it is a situation where it has not gotten extended as some of the other ones. Boeing went nuts because they got a big contract for airplanes. And so the industrial sector has been helped by that. So let's take a look at the industrial sector right now. The Vanguard ETF is VIS. And let's see what that's showing you. Yeah, as you can see, big move up, big move up. Okay, and of course, Boeing and companies like that caused that. Again, this would be a time to think about maybe throwing a put in if you think it's come too fast, too far. Do a little collar strategy if you want to try to protect some of that gain. Some of you guys are in there at 150. There's no gains to be had. If you're in there all last year, then that's the story. Okay, so that's the industrial sector. Some of these, again, look pretty extended. Let's take a look at another one, which would be the financials. Everybody's been touting those so long, I'm tired of hearing about it. Okay, there you go. The Vanguard the thing. We've had a little bit of a pop in financials, but they're kind of looking like they're having some trouble up here as well. So again, all these high points could be trouble. If we're going to go to the 2900 area, then you probably pop to 70, and you can see there's a lot of resistance on this ETF around 70. But again, the financials have improved from the December. And again, if you want to put what happened in perspective, let's do, in my opinion, here's what's going on. In December, everybody thought the Fed was going to hike 4 times this year. Then in January, they said, no way. That's a big change. Everyone in December thought the earnings were going to totally dry up and the GDP was going to dry up. That totally didn't happen. GDP this came out for the fourth quarter, 2.6%. You know what the estimate was? 1.9. You know how much of a miss that is? 40%. So that's a miscalculation of 40% on the fourth quarter GDP. What other miscalculations could be coming down the pike? My feeling is their inflationary expectations are definitely being miscalculated. Now, the other thing that could be miscalculated is the earnings, because people are thinking the earnings are not going to be there. Right now, they're looking at it's priced about 5%. for earnings this year, 5% growth, much less than last year because there's no tax cut, right? But you are looking at a situation where if that number went back towards zero, then obviously that's a miscalculation, and that would send the stock prices down because valuations would be almost 18 to 1 PE ratio at that point. Right now, it's around 16, so it's certainly not cheap right here. That's why Buffett said things don't look very cheap, right? Well, if things don't look very cheap, then obviously that might be one indicator that they don't have that much further to run. Again, let the numbers tell you, you don't tell the numbers, right? So if the tape starts rolling over next week, again, that would be something to respect because you've had a pretty big run. All right, let's take a look at another sector that people have been talking about, which is materials, which again have had a pretty good move. And if we're going to have, a good economy and a robust situation, infrastructure, maybe, I don't know, materials, right? So if that's going to happen with infrastructure this year, maybe later in the year, this thing could have more legs. It's had a bit of a run, but not like the other ones. So keep an eye on materials. They could have more to run. Pullback should hold 120 based on the chart there. And then if it starts making new highs, there could be more to come, particularly if they ever get to infrastructure and stuff like that. Okay, let's take a look at another one is the healthcare. Now that seems to be the bloom coming off the rose a little bit here. United Healthcare had rolled over just a little bit. Let's see what it's doing today. This is going to be the ETF on healthcare. And there it is. Okay, it's up a little bit today, up 1%. So it's banging back up to the upside. It did start rolling over a little bit. Still looks very strong. Obviously, the demographics are fabulous for healthcare, particularly when, obviously the cost of going to a doctor and getting drugs remains off the charts. Bottom line is you're still up there at 175. Had a big move from 150. If it starts taking out 172 here, I guess that would be an indication that it could be rolling back over. Let's take a look at United Healthcare because that was looking a little bit like it could be hitting a high point. Let's take a look here. No, it's up big today, 1.5. So they must be catching some shorts. Well, it did roll over quite a bit though. Yeah, there you go, and on pretty big volume. Yeah. So the providers obviously are a little bit losing their luster. So there you go. Double top up there, not dissimilar to that ETF. And then, of course, it did roll over. And look at the volume. But when the volume's that big, sometimes it's a buying point. You see the volume here? Boom, down to 230. What should you do with that kind of volume and that kind of price? Looks like you should have bought it, right? Right now, huge volume again, low price at 240. If you want to take a bite down here, you don't want it to take out 240. And where could it run back up? Well, you see that gap right up there. If things turn, maybe it'll go up and try to fill that gap. Who knows? But the bottom line is that is a high volume sell-off, and sometimes that corresponds with a low price. Keep an eye on that. Okay. Any other sectors I wanted to bring to your attention? Let's see. Oh, yeah. Where are people hiding out? Let's see if they're hiding out in utilities. Here you go. VPU. And there's many ETFs. I'm just using this as for illustrative purposes only. You've got this up at 126. Let's see how you would have done like say you owned it in November. Look at this. While everyone was losing their shirt, right? And the thing came down in December. Basically, it was stable throughout the whole month of December after it dropped, and then it's been matriculating up the whole time. And you're getting 3.22% dividend while you're holding on to it. So you're getting a good yield, and you've had price appreciation. That has not been a terrible place to hide into. If interest rates are going to roll back up, which we're going to get into right this second, you'd want to be careful. Right now, I'm just going to show you an ETF, a REIT that I keep an eye on from time to time. It's also been fairly stable with a good yield. Let's talk about Annaly. And again, during the crisis in December, people who hit out here, let me show you there. Hold on. There you go. In December, came down here, but it's been trading in a 25-cent range here during that whole period, right? 25-cent range in that period between 9.75 and 9.50. Had a nice pop up of 75 cents. That's a pretty good jump. And then, of course, it's pulled back now. So it's been going. And then that high volume sell-off corresponds with the lower price there. So that's a pretty good line in the sand, 9.75. And then basically, if you notice, the yield is almost 12%. So you're getting 12% cash flow right now to look at the movie. And basically, that's one of the places where people have kind of stalled some of their money who are willing to take the risk of a REIT. All right. Now, the last thing I was going to get into, and then I'm going to sign off, is the interest rate picture, which I brought to your attention as well. This is the 10-year note. Okay, it's up to 274 now. And as you can see, when it was up at 325, the moving average was down in the 275, $3 area, 3% area, right? So obviously it's overbought. It came down and went all the way through it. Now down here is 2.5, right? And now we don't look like we're approaching that anymore. It looks like it has all that support there, and it looks like it's trying to take off. If yields get above 280, I think you're going to 3 to fill in that gap. So yields may very well rise if it can get above 2.8, and it's at 2.74 right now. That'll fly directly in the face of what many people are thinking. All right, I've got to hop. I'll be back next Friday, but I'm encouraging you to tell your friends to go to OptionProfessor.com and get a weekly update, because I cover the gauntlet, as you can see. And also shoot me an email at OptionProfessor@gmail.com. And let's talk if you have any questions on anything I covered. Until next Friday, I'd like to wish you all a very good week trading, and I'll be back with you next week.